Welcome to Hanken Cash Club. I hope your day started with money. Now, the first video on this channel will be analyzing stocks, and I got a very special one for you today. So, without further ado, let's jump right into it with Crocs. And yeah, the issues are controversial, but I do honestly like the clogs, and they're very popular with other people too. And then they have sandals and these gibbets which you place on the Crocs to make them very unique for yourself. And I mean, the stock hasn't been doing very well. Over the last year, it's down 20%, and for the last about 3 years, the stock hasn't gone anywhere. But why? Well, mostly because they had a huge growth during the pandemic, which kind of stopped. And then also they had an acquisition of the brand Hey Dude, which really didn't provide much for shareholders. So I mean, they're trying to get more diversification out of the like clogs and try to avoid just being one trend company. But yeah, I mean, the shoes are alright, but let's see how it goes. For the financials, CROX is about 80% of the company, and Hey Dude is 20%, and about 50% is wholesale, which means like through Crocs stores and other stores as well, and then 50% is direct to consumer, which would be like buying from the Crocs website. Then 45% is international, while 55% is North America. And I think this is actually one of the things that people miss. I mean, the international growth, that's 12%, and the North America one was 3%. And meanwhile, the whole company isn't growing that much. I think it's the international part that is going to sort of carry it away. And especially in China, they're growing well, very well. Also, the fact that they're now trying to do more direct to consumer would be one thing that could improve margins. Because wholesale, of course, you have more employees and retail space, and it's going to cost more to sell those things. And here we can compare the revenues. So it was about 937 million for the first quarter for the whole company. And Crocs brand grew 4%, which you can see split up between North America and international. And then Hey Dude actually declined 10%. And this Hey Dude brand is sort of why the stock is also in the shitter, because they paid a lot of money for the company and it's not really performing. Gross margins improved for the company and Crocs, but decreased for Hey Dude. Continuing with margins, selling general and administrative as a percent of revenue rose, which meant operating income and margin decreased. Adjusted diluted EPS is 3, which I mean, if you annualize that, it becomes 12, which if you look at 12 compared to the stock price of 106, they're trading quite cheaply. So, what does the company think about themselves? Well, global leader in casual footwear with two iconic brands, and then also a strong value proposition with assortments under $100, taking market share. And I think this one is pretty big also if you consider fashion and recessions. And we may be entering one, it's not really sure, but people don't really like to buy sort of stocks like Nike or Lululemon or things like that because consumers might decrease their spending. But with Crocs, they seem to have sort of the cheaper products, which would actually possibly make them more resistant to a recession. And yeah, they also want to keep growing with top tier margins and cash flow generation. We'll see about that, but anyways, capital allocation. They want to invest in their brands, do debt pay down, and they want to keep a leverage range of 1 to 1.5, which at Q1 trailing 12 months is about 1.55. So expect them to pay a little bit down of debt, but then pretty much stay where they are. They also want to repurchase shares, and they have a huge buyback authorization going, but they don't really purchase that much back. Of course, they can't afford it, but during the last year, they did buy back about 7.5% of the total outstanding shares, which is pretty big. So, what about the actual financial reports? Well, as a $6 billion market cap company, you can see their net income is quite okay at around 950. Earlier, they did have 800, 540, 700, which would still be a lot for a $6 billion market cap. And the cash flow slightly lower at around 900 or 800 or about that, but you can see that it's still quite a lot. So about the valuation then, because that's always the most important thing at the Hanken Cash Club. I constructed this valuation model and I tried to see what's kind of priced into the stock because that's really my thesis here. I mean, it's not really the best company, not the most secure. They don't have a lot of growth, but they're really, really, really cheap, I think. So looking at what's counted in, I projected 0% growth for this year and 2% through 2028 and cash flow margin of 20% compared to 21.5, and then free cash flow would be lower in 2028 than it was last quarter. In the last quarter, they had a multiple of 6.6 times, and I really do think that's kind of too cheap to ignore. So I'm really betting on the multiple expansion, and if we bet 11 times for this scenario, we'd have a market cap of 9.6 billion. And yeah, that's about 60% higher than it is now. But if we take into account 8% of buybacks, which they should be able to achieve if they're now trading at 6.5 times cash flow, then that would be an upside of 107%, or until February 2029, 17.5% CAGR. So that's quite a massive return, even with these kind of pessimistic assumptions, because I also think it's highly possible that they would grow more, that their free cash flow margin would be higher or buybacks higher, and that could really explode the return you could get as a shareholder. But I mean, if we really do want to be pessimistic, then we can like assume no growth at all, and we can assume maybe 18 times free cash flow margin and a 10 times multiple, and then you'd get around a still 70% upside with 12.5% CAGR. So I really do see no such scenario where you would at least lose a lot of money. It kind of seems like all of it's sort of in the positive. And if you want to assume these sorts of numbers, then you're really assuming that this brand, Crocs, is kind of declining more than tobacco brands or declining more than sort of the worst industries out there. If you look at British American tobacco, for example, I bought when sort of the projections other people were doing looked like this. And you really have to have just a little bit of faith for it to be a really good investment. And I'm not saying that you should go put a lot of money into this because, of course, it is possible that they decline, free cash flow would get wiped out, and you could still lose 50% of your money. But keeping this as a smaller position in your portfolio could really be great for the overall returns. If you wanted to assume these numbers I have currently on the screen, then for a double, you'd have to buy it for $90. Shit, I have the wrong currency. $90, and the stock was there not too long ago. So, I mean, you could put a price alert on your watch list for that amount. It might hit there, but it might not. It might shoot up. But at least, like below 100, I would be really interested in having this one in my portfolio. So, thank you for watching. I'm going to try to put more content on this channel. And if you have some thoughts, please leave it in the comments. And as always, keep cashing.